Hi, everyone. Well, it's the time to start the webinar, and here we go. I welcome you all. Today's topic is accounting policies, changes in accounting estimates, and errors. Myself, me, Ahmed Farhan. I'm fellow member chartered accountant and partner at Crest Cooper, Chartered Accountants, Dubai. Wonderful. So what today we will be discussing is the overview of the standard. This is in fact IAS 8. And what is accounting policy, how this accounting policy and accounting estimates are considered different, or when change in accounting policy happens and the change in accounting estimates take place, how those are accounted for. In the same way, the errors which have happened in the past years, if we got to know about those errors in the current year, what accounting treatment is required. And certainly we'll talk about their disclosures. So the thing is that IAS 8, as I told you, it talks about the criteria for selecting the accounting policies and to account for those policies if they get changed. It also talks about the accounting treatment and disclosure of the changes in accounting policies, changes in accounting estimates, and the correction of errors. These errors belong to the past year or years even. After knowing about these errors, the past year's financial statements are no more considered to be reliable. That's why their accounting is required for reflecting the change in the beginning balance of the earliest period presented. We will discuss it with certain numerical examples. In fact, the aim of IAS 8 is to enhance the comparability of the information which we put in the current year with the information with the previous years. So this is in fact the basic ideology of IAS 8. The very first thing that I want to discuss with you is the difference between accounting policy and the accounting estimates. Often people, they get confused over the distinction of these two terminologies. In fact, accounting policy is the method or treatment in accounting which is required by the regulator or by the accounting standard. It is not something that depends on the circumstances. Rather, the regulator is imposing the accounting treatment on the entity, or the standard is imposing the accounting treatment on the entity. For example, to depreciate property, plant, and equipment, is an accounting policy. This policy is imposed by, I'm using a strong word, you can say advised by the accounting standard, and we follow it, that all the property, plant, and equipment, except obviously the land, or you can say which meet certain criteria, are subject to depreciation, must be depreciated. So we cannot say that we are not going to depreciate certain assets because we don't want to. So here the regulator or the standard is asking an accounting treatment, whereas the accounting estimate is the approximation of the monetary value that we give to an accounting treatment. For example, the accounting treatment is to depreciate property, plant, and equipment. What should be the depreciation rate? This depends on the environment in which that property, plant, and equipment item would be used. For example, if you are having an air conditioning plant which is providing its benefit to the workshop which is exposed to heat, and comparatively on the same date you install an air conditioning plant in a conference room, obviously both air conditioning plants would be carrying two different useful lives. So depending on their useful life, the depreciation rate will be determined. So this determination of the depreciation rate to calculate an approximate amount of the value of the depreciation is an accounting estimate. So accounting estimate is merely an approximation which is made by an expert, remember. Accountant is not an expert for determining a useful life of an asset. Okay. So the accounting estimate is made by an expert having relevant knowledge and expertise, whereas the accounting policy is advised by or imposed by the accounting standards, what the entity is following, or the regulator in the economy which the entity is working. So the accounting policy is obviously selected. So the selection of the accounting policy is based on some basic requirements. This is what I'll be discussing with you. As I told you that accounting policies are the specific accounting principles or bases or conventions, methods, rules, etc. In simple terms, you can say accounting treatment. Accounting policies are the specific accounting treatment which are applied by an entity in preparing and presenting its financial statements. So those accounting policies could be internally developed if those are not of that sensitive nature, or you can say the regulator accepts that accordingly, or would be imposed or asked by the regulator or the standard setting board, or a framework, you can say. For example, when you internally create an accounting policy, that could be like a credit policy or discount policy, that settlement discount would be given to the certain like customers for how long. Okay, so that is also a policy. Okay, but like the policy of the areas which are sensitive in preparing and presenting the financial statements are externally imposed. So these are in fact when an IFRS specifically applies to a transaction, the accounting policies defined for such transaction must incorporate IFRS. Okay. The incorporation of IFRS into accounting policy is only required when the effect of doing so is material, remember, to the resulting financial statements. This is very important sentence, which the accountants must understand, because ISB conceptual framework tells us that the financial information should carry qualitative characteristics. And there are two fundamental qualitative characteristics in which the first one is relevance. And in that fundamental qualitative characteristics, the framework tells us that information should be material enough to be a relevant information, because relevant means the information based on which the users will be taking some decisions. So if the policy is addressing to an accounting treatment which is having an immaterial, insignificant accounting impact, you may forego that. For example, depreciation, let's take the same example. The asset is of an immaterial amount, and when we will be looking into its estimated useful life, supposedly 5 years, and say that is of supposedly $1,000. Okay, and when we say like 5 years useful life, it would be like giving us 200 per annum. So it is an immaterial amount. We can say that we are not going to depreciate this asset. Rather, we will not be capitalizing this asset in our financials and would be charged to profit and loss. So materiality is something very important while selecting and applying accounting policy. Whatever the accounting policy once selected for preparation of the financial statements should be consistently applied. We cannot change the accounting policies. For example, there is an accounting policy for measuring the cost of inventory, FIFO or weighted average based. Supposedly, if we are following FIFO for a specific inventory to measure its cost, we cannot in the next year change it to the weighted average, and then in the next to the next year in the FIFO, and then again weighted average. This is not consistency, because the end result would be different, and the financial statements, as I told you earlier, would no more be comparable. In order to make the financial statements comparable, it is important that the policy once adopted should be consistently applied over the years. In the same way, like I have given an example of IAS 16, where we can either use cost model or revaluation model for measurement of the property, plant, and equipment after its initial recognition. So whatever the model once selected for its subsequent measurement will be followed for the upcoming years consistently. Question arises, if it is this much emphasized that accounting policy once adopted should not be changed, then why this standard is talking about the change in accounting policies. Yes, this is very important area. The thing is that there could be certain circumstances in which the policy change will take place. One of those is the policy is being changed because of the requirement of a new accounting standard or a change in the accounting standard suggested by the board, IASB, International Accounting Standard Board. For example, years ago, almost 20, 25 years almost, I guess, when IAS 23 was talking about the charging out the borrowing cost to profit loss account. But then the policy was changed in the standard that if it is being incurred for a qualifying asset, it must be capitalized. Then there is no option to charge to profit loss or to capitalize. So that option was eliminated then. So it means there was a change brought in an existing accounting standard. Then what happened in the previous few years, like 2018 onwards, the policy about the leasing was changed, about the revenue recognition was changed, about the financial instruments was changed. So whatever the policy suggested in the new accounting standards, as you saw, like earlier there was IAS 18 talking about the revenue recognition. Now it is IFRS 15. So 18 is no more existing. That has been superseded. In the same way, the IAS 17 about leases has been superseded, and now IFRS 16 is talking about the accounting for leases. So the policies based on the requirements of the accounting framework which the entity is following, if those get changed, obviously the policy will be changed. Otherwise, there is one more reason that is there for the change in accounting policy, which is a volunteer change. Means, as I told you, that there are two policies, measurement methods, which is taken as a policy for IS2 inventory. Supposedly, the economic environment is based on inflation, or the inflation has been controlled, whatever there is, in which the entity assumes that now onwards the FIFO is not giving us the appropriate results. Rather, the weighted average will be giving us the more fair picture of the financial position of the entity. Therefore, they are deciding to change the accounting policy. Again, this is allowed, although it is not like a change brought in by the new standard. It was already existing in the standard, and among those two, we adopted the one. Now we are voluntarily changing that based on a certain reason. In the same way, let me talk about the same IAS 16, property, plant, and equipment. Entity assumes that we should present our financial statements based on the current value, not based on the historical cost. Therefore, the assets altogether needs revaluation. So this is a policy to remeasure our property, plant, and equipment items at fair value, leaving a revaluation surplus. So again, this is something already existing in IAS 16. So we are switching from one to the other method. So this is accounting policy change. Okay, so these are the two reasons based on which the change may take place. So the rule of thumb for the change in accounting policy is that if the change is required by the new standard, obviously the standard will give you a proper guideline that how this change should be accounted for. That guideline that the new standard is providing is known as transitional provision. So that transitional provision, how to account for the change during this transition of change, is provided by the new standard or the changed standard. If it is not the case, then the change in accounting policy will be reflected in the financial statements based on retrospective application. Retrospective means that altogether such financial information would be changed as if the changed, means the new accounting policy, was in its application from the very beginning. Okay, so we will calculate its accounting impacts right from the beginning when the policy was first adopted, and from there onwards, when the policy is being changed, the accounting impact will be reflected in the opening balance of the retained earning, and the relevant information would be amended accordingly. So the question arises, might be going back this much, like in the retrospect, could not be possible. So if the accountants, they prove it that it is not practically possible to dig out the past, certain basic information is not available, then standard allows us that go to that extent till date it is practically possible, and from that date onwards give the retrospective application of the change in accounting policy and give a disclosure that it was done because of something which was not practically possible. So if it is impractical to determine period specific effects or cumulative effects of the change in accounting policy, then apply retrospectively to the earliest period that is practically possible. Well, there are certain disclosures which we need to put in our notes. It is like designed in a way that if the policy change is based on the new standard or a change in the standard, in which case I told you that there would be a transitional provision, or the second column is if the change is happening voluntarily, like from FIFO to weighted average or from cost to the revaluation model. So if the case is like change in IFRS, the title of the standard, the new standard, or IFRIC, okay, that caused the change should be disclosed. Obviously, it is not required in the voluntary changes. Then description of that transitional provision, again, it is required if the change is being made based on the new standard, and this transitional provision does not exist when we voluntarily making such change. Nature of the change in accounting policy should be disclosed in both cases. For the current period and each prior period presented, the amount of the adjustment to each line item affected, like depreciation is a line item. property, plant, and equipment is a line item, and might be the impairment loss would be changed. Okay, it's a line item. And excuse me, ultimate impact on the earnings per share should be disclosed, because obviously the earnings would be different because of the change in policy. This policy will impact the gain or loss on the profit or loss, and the earnings available for distribution to the equity shareholders would be changed, and this will bring change in EPS. Then amount of the adjustment relating to prior period not presented. Okay, the presented financial statements means the comparative financial statements. Just read the line once again. Amount of the adjustment relating to the prior periods not presented. Normally what you see, the financial statement is provided for 2 years, the current year and the past year. Past year is the comparative year. So these 2 years are being presented in the financial statement. Supposedly, if the regulator asks to present the financial statements for supposedly 3 years or 4 years or 5 years, so those current plus 4 are the presented period. Since I told you that retrospective application is required in this change in accounting policy, therefore, supposedly the 2 years are presented period, the previous 3, 4, 5, 10, 20 years whatsoever are the period which are not presented. So the financial impact belonging to that period, which is not being presented in the financial statements today, needs to be disclosed. Reason why the new accounting policy provides reliable and more relevant information. This is not required in terms of the change in IFRS. This is a requirement to be disclosed when we are doing volunteer changing. So that change means, like, if you are changing from 5-4 to weighted average based on the inflation impact, then you will be disclosing this, that because of the change in the economy, we are bringing this change in our accounting policy. If retrospective application is impracticable, explain and describe how the change in policy was applied, means till which date we went back and then we made the change and why that was impracticable. Subsequent periods need not repeat these disclosures. Once you have given these disclosure of the change in accounting policy, in the next year and next to the next years, we don't need to repeat these disclosures. So means these disclosures would be required in the year in which the accounting policy is changed. Let me give you 1 or 2 very simple illustrations to understand the concept more clearly. Sample company changes from the weighted average method of inventory costing to the FIFO method, first in, first out. Doing so results in an increase of 50,000 in the cost of ending inventory, which in turn increases the profit for the period. So when ending inventory will increase, we know the cost of goods sold will decrease. And the profits will increase. Obviously, when the cost of goods sold will decrease, the profits will increase. So these are the line items which are being changed. In the same way, in the current assets, the amount of inventory will be changed. There is another example where sample company used to account for revenue at the time of dispatching the goods. So the concept was that when the goods will be dispatched, then it will be assumed that the control has been transferred to the customer. Therefore, the entity should recognize the revenue. But if uh, there is some a change in transferring the control to the customer, the point in time when the customer will be assuming the control over the goods, then obviously altogether the sales revenue would be changed. So what came up that they observed that over the years, instances of goods dispatched being rejected by customers at the time of receiving the goods, which is increasing. Means when you are dispatching, you are saying that now the control is to the has been passed to the customer when at the time of dispatching from your factory gate. And customer was saying, okay, that's fine. But over the years, what happened that customers keep on complaining that the goods that you have dispatched are not in good quantity or good quality, or there is a scratch. Okay, some sort of complaints were uh, increasing. So the customers, they said that no, we will not take its control right from your gate. Rather, we will tell you that how much quantity and of what quality we have received the goods. Therefore, the control should be passed on to them on this point in time when they will acknowledge that this much goods have been received. So obviously, if the goods have lost on the way or damaged during the transit, those goods would be returned or would not be considered as your sales revenue. So the sales revenue would obviously be reduced because of such change in accounting policy. So also due to unreliable courier services, quantity received by customers was often less than the quantity dispatched. The directors therefore decided the revenue should be recognized after receiving the acknowledgement. Supposedly there is no standard that is addressing this issue. Supposedly I'm saying. So you will use your own judgment to make your accounting policy in this regard. So that accounting policy, as I told you, internally can be made. So that accounting policy is now changed. So change in this accounting policy will cause an impact in the number of sales revenue. So the financial statements before the change was that sales in the current year was 300,000, in the previous was 291,000. Just leave the other information for the time being and jump on the next slide. So the sales of 300,000 and 291,000 based on the current scenario will be changed, and the relevant amount of goods dispatched but not received in the relevant years by the customers are as under that. In the current year 2002, the sales of 37,000 not received means it will be reduced. Okay. And in the previous year, X1, 35,000, and in the previous year. So this is the issue of not received, means these would have been received in the next year. So in the previous year, the sales would be reduced or adjusted by reducing the sales with this amount, and the upcoming year will be increased with this amount. Like for example, in the year 2000 X0, the sales will be reduced by 30,000, and the same amount will be included in the year 2000 X1. And in the year 2000 X1, the sales will be reduced with the amount 35,000. This 35,000 will be included in the year 2000 X2. And same goes with this. X2 sales will be reduced with 37,000, and these will be included in the sales of 2000 X3. So memorize these three figures and see in the previous slide. The sales of 2000 X0 will be reduced by 30,000. Okay. Sales of 2000 X1 will include this 30,000 and will be reduced by how much? 35,000. And this sales of 300,000 will be reduced by 37,000 and will be increased by 35,000 from there. So this I have worked out over here. If you see the working over here, 2000x1, 30,000 is coming up from the year 2000 x0. This 35,000, the year x1 sales is being reduced and being added in the year x2, and this will be subtracted from x2 and will be taken in x3, which is not the part of this financial statement. Okay, so this is the impact that we will be providing in the sales revenue of the period presented. Okay, this is not the period presented. X0 is not the period presented. The next question arises when we will be making change in the sales revenue. Obviously, the cost of goods sold should match with the sales revenue. That would also be changed. So over here, you can make a judgment that it is 2/3 of the sales. If you calculate, this is exactly 2/3 of the sales. The same impact 2/3 you will work out for the year 2000 x0, so that the impact of gross profit would be 1/3. So its gross profit will be reduced by 1/3, so on and so forth. Okay. The impact of gross profit of the previous year not presented will be reflected in the opening balance of the presented financial statement or the presented period, earliest presented period. Earliest presented period is 2000 x1 in this case. What happens that the profit will be impacted equal to 10,000, and the taxation rate that we can take from here will be subtracted from it, so that the profit after tax will be impacted with the amount of 6,700. So this 6,700 will be reflected in the opening balance of the retained earning of the earliest presented period. Now just come up and see that this is the part of this scenario. The opening balance is provided. Okay, and the profit we took from the financial statements 46 and 44. 46 and 44. This is the amount of dividend paid. So this will be changed, 46 and this 44, along with the change in this 30,000. This 30,000 opening balance will be impacted with the 6,700. Okay, so this 6,700 will have an impact because the previous year's profits are, excuse me, the previous year's profits are being reduced, and because of which our opening balance will be adjusted. So it will be adjusted to 23,300. This 44 will be corrected in a way or based on the changed scenario. There will be no change in this 30,000. It will be changed. The same changed figure will come up over here. Then the changed profit for the year will be taken. Dividend, no change, and so on and so forth. Just have a look on it. So this 286,000 coming up from here, like sales, the change that we took from W1, working one, okay, and the retained earning that we made and a change in there. This is the change, restated opening balance of the earliest period presented, the restated profit figure, so on and so forth. So you can work it out easily. Now you have understood that how to account for the things and the disclosures as we discussed earlier are being presented over here. Let me take you through the accounting estimates, change in accounting estimates. So change in accounting estimate is an adjustment of the carrying amount of assets or liability or the related expenses or income resulting from reassessing the expected future benefits and the obligation associated with the assets or liabilities based on the changed scenario. The amended definition of accounting estimate is now that it is a monetary amount in financial statement that are subject to measurement uncertainties. The rule of thumb over here is that whenever we work out the change in accounting estimate, its accounting is always reflecting the reporting period and the future period if it is impacted. So recognize the change prospectively. It is termed as prospective treatment in the profit loss period of the change, if it only affects that period, or period of the change and the future if applicable. The change in accounting estimate and accounting policy, I have discussed a lot on it, therefore I'll not reiterate over here just to manage the time. The disclosure requirements are nature and amount of change that has an impact in the current reporting period needs disclosure, and the fact that the effect of future periods is not disclosed because of its impracticality. It means it is something we disclose. And here I just wrote few accounting policies and the accounting estimates just for the sake of like clarity. Depreciation is an accounting policy. Okay, cost model or revaluation model is an accounting policy, whereas depreciation rate, useful life method is accounting estimate. Remember, mostly people they get confused in in depreciation methods, that why depreciation method is accounting estimate. Who is determining, who the expert is determining this depreciation method? Look, the standard guides us that if you need to select an accounting method, depreciation method, you should be looking into the pattern of economic benefit. So the pattern of economic benefit is judged by the expert relevant to that asset in the scenario in which the asset will be providing economic benefits. That's why this is accounting estimate, not accounting policy. Here I've given an illustration in which the depreciation method and the depreciation rate is being changed. So it is taken as accounting estimate. Again, there is an illustration in which the non-current asset was purchased for 200,000 2 years ago when its expected economic life was estimated 10 years. Again, this is a change in the useful life and the depreciation method. It is again accounting estimate. There's one very important point that I want to discuss with you, that is like about the calculation of the number of years in which like the depreciation is charged. In fact, it starts from the beginning of the year in which the asset was put in use, okay? And we assume that it was like started from the very first day, no proportionate calculation. Mostly what happens that if the depreciation year is being changed, supposedly after 1 year, and it's saying that its remaining life is 4 years, like supposedly it's saying its remaining life is 4 years, 1, 2, 3, 4, 5 years, supposedly. Okay. So we erroneously divide it by 5. It is not the case. In fact, this year needs to be depreciated as well. Although on this date means on the last day of the current reporting period, we are saying its remaining useful life is 5 years. Where is the depreciation for this? So the re-estimated useful life for that scenario should be 6 years, okay? Not the 5 years. So this is important. Errors based on which the previous financial statements are no more reliable. This could be any error, even fraud is also accounted for accordingly if detected. Okay. So prior period errors are omission from and misstatements in an entity's financial statements for one or more prior periods arising from the failure to use or misuse of reliable information in recognition, measurement, presentation, or disclosure of the financial statements. So error may include mathematical error or fraud, etc., whatsoever. The rule of thumb for accounting treatment to rectify such error is that we do retrospective restatement, exactly the same thing that you have gone through in the accounting policy change. Okay. So what we do, we restate the comparative amounts of the prior period in which error occurred, or if the error occurred before that date, then restate opening balance of the assets, liability, and equity for the earliest period presented. Again, the earliest period presented is the comparative information, the comparative column. So what we do, in fact, we are preparing 3 financial statements, you can say. First is the current period. Second is the previous period, which is the comparative period. And the third is, in fact, reflecting the changed assets and changed liabilities and the changed amount of equity representing the opening balance of the previous year. Previous year means the comparative year. So supposedly if you're preparing financial statements for the year ending on 31st December 24, the period ending on 31st December 2023 is the comparative year. Obviously, this period begins from 1st January 2023. So we will prepare a balance sheet on 1st January 2023. Okay. The earliest period presented, the beginning balance of the earliest period presented. So this is the third balance sheet that we will be preparing in this case. So if practical, to determine the period specific effect of the error or cumulative effect of the errors, then restate opening balances, restate comparative information from the earliest period, which is practically possible. The same thing that we discussed in the change in accounting policy. Let's quickly go through the illustration on it. In preparing the financial statements for the year ending on 31st December 22, sample company discovers an error affecting the 31st December 21 financial statements. The error should be corrected in the year 31st December 22 financial statements by restating the comparative figures for 31. Okay. This is what, in fact, I was discussing with you in the previous working, and the disclosure required in this case is nature of the prior period error. For each period presented, if practicable, disclose the correction of the each line item affected and the EPS, earnings per share, impact on EPS. The same disclosure that we discussed in accounting policies change. Amount of the correction at the beginning of earliest period presented. If retrospective application is impracticable, explain and describe how the error was corrected, and subsequent periods need not to repeat these disclosures. So this is the illustration in which we see that Chief Accountant of Careless Limited has prepared following financial statements, in which the sales, cost of sales, gross profit, operating expenses, and the profit after tax is given. And the statement of changes in equity you can see over here. the beginning balance and the profit after tax and the dividend. So what errors took place in fact? During the audit, it was discovered that sales for the year ending 31st December and 31st December X0 and X1 amounting 500,000, 700,000 respectively had been omitted and have been included in the sales for the year 20 X2 altogether. That was omitted. So what we'll do? We will reduce the sales for X2 and increase the previous 2 years sales, because of which the impact on opening retained earning will be increased. However, relevant cost was properly, its cost of goods sold was properly accounted for, so we don't need to change the cost of goods sold figure now. So the treatment I have discussed with you. Auditor also pointed out the operating expenses for the year X2, that is 3 million. Included overtime pay for the year X1 amounted to rupees 150. So the expenses appearing in the X2, which is 3 million, it is including 150,000, which was approved and disbursed in February X2. It belongs to X1. So based on the accrual basis, it should have been recognized in X1 as an expense, whereas it has been included in the expenses of X2. So again, here we will be reducing the expenses of X2. So we'll be reducing the sales revenue of X2 with 1.2 million and expenses of X2 with 150,000. Net impact, we'll see how it will change the figures. So the sales of X1 will be increased and operating expense of X1 will be increased. Its tax expense will be increased, profit will be increased. All this is like something, its debtor will be increased because of the change in sales. Increase in expense payable will be reflected over there. Increase in tax payable will be reflected over there. Increase in equity. So this is what like we'll be having an impact in the third balance sheet that I was saying. Or here, like the expense that got changed that belong to in fact X1 only. For X0, the only change will be reflecting for the sales and its impact on tax and debtors, etc. Okay. These are the working that how the sales, which was not recorded in their relevant years, which was wrongly recorded in the sales of X2. So these two sales will be subtracted from X2 and will be added 700 in the X1, and in the X1 the expense will be subtracted. So altogether the changed figure, we have given the references of the working. The changed figure you will see are appearing with the reference W1, W2, W3, W4 here, and the ultimate net impact you will be having in the retained earnings. Okay, so that's it, and thank you so very much. Please let me know if you have any question on the topic. We'll take it, or otherwise if it's all good, then thank you. And there is a disclaimer, like because I have taken a few illustrations from other sources which I put over here. So that is only for the sake of like giving you the clarity on the topic. Okay. We are representing Crash Cooper, and we are having business in US, UK, UAE, and New Zealand. And for the accounting, finance, taxation, audit related services, you may contact us. Thank you very much. God bless you all. Bye-bye.